Welcome to our High Rock monthly video for November. I'm Scott Tomlinson, and with me on the call is Paul Tepsich, our founder of High Rock and the portfolio manager. And we're going to talk a little bit about what happened in October. Most equity markets were higher in October, and this is a bounce back from a pretty dismal September, and you all may remember. And you have received your quarterly reports as of September 30th. So things have improved since then, and I guess that's a good thing, especially in equity markets. Paul, do you have anything that you want to add?
Yeah, it's actually interesting how gold and silver were pretty poor performers even through the end of the month. That's certainly one asset class that has got us dumbfounded, but given the inflation that's going on, a lot of this is really related to the US dollar, which we don't really have a chart. Maybe we should have put one in, Scott, but as the US dollar kind of gave up some ground late in the month, we saw US priced asset classes do better, everything from commodities to stocks, etc. So it's that was a big
flight to back to more risk assets as opposed to safe assets, right?
Right, exactly. So, and that's reflective here in this chart in the past week of or the last week, pardon me, of October. Yeah, it was quite a month for sure.
Indeed. And it helped balance portfolios over the course of the month. The iShares Core Balanced ETF XBAL that we monitor as a benchmark for our client portfolios was improved, although still down 13.75% year to date. And if clients are looking at their portfolios for comparison, most of our clients, especially in the balanced mandates, will find that they're performing much better than this benchmark. So, and of course, I'm always available to answer questions about this. If anybody has any questions about their portfolio and want to discuss that in more detail, please always feel free to get in touch. Paul, how about our special mandates this month? They did reasonably well.
Yeah, they had a good month. They certainly kept track with most of the other risk assets like equities. And they've had a very good year to date. They certainly have, every single one of them have one double digit positive sign, kind of mid double digits, one, and the rest of them are all well above zero year to date. So they've had a great run given what's happened in the world, what's happened in US high yield and even Canadian high yield. And a lot of that has been centered around a pretty heavy weight we've had for the past few years in energy bonds. And again, Scott, some of those energy bonds we own in our tactical model within the private client division, the balanced mandates. So that's we'll talk a bit more about that as we go through each of our three models for the balanced clients.
Sure, but the exposure to that energy asset class has been a great mitigator of the downside for our client balance portfolios, especially those who have a little bit heavier weighting in the tactical model.
Yeah, for sure.
Again, we're always talking about the long term, and I know it's boring for me to say this every time, but we do focus on that over the long term. We've obviously through post 2008, 2009 bounce back, 10-year good, strong equity markets, but looking forward, we expect that that's not going to be the case, and that we have to be more tactical. We have to be a little bit more value add with looking for opportunity, and it's not going to be as good for those kind of portfolios that are more passive. So we need to be just a little bit more active in our portfolios to try and stay better than the benchmark returns. Most recently, the big news: Federal Reserve, Paul, raised interest rates by 0.75 point. Now it's the guessing game as to what happens next. As I know you've talked about, and we've talked about in the past, we do think there has been a peak to inflation, that inflation should start to be moderating to a degree, but I guess it's a sense of how that plays out going forward that will inspire what comes next from the US Federal Reserve and, of course, the Bank of Canada and all the rest of the central banks globally. Any comments to make?
Yeah, I mean, that is obviously the $64,000 question is, has inflation peaked? Number one, has employment peaked? Number two, and is there still, as the Fed would see it, asset price inflation that they want to hit down further, i.e., quite frankly, I think they're managing the stock market. I don't think they want to see a lot of leverage, people borrowing money and buying, whether it's cryptocurrencies or equities or corporate bonds, any risk assets, housing, you name it. I think they want to remove speculation from the market. So when we talk about inflation, as this chart shows, we're either talking about consumer price inflation, or this chart shows PCE, which is another form of personal consumption expenditures that the Fed watches. But there's also asset price inflation, housing, stocks, et cetera, as we mentioned. So it's a really tough call. As you can see in the blue line, they've raised and they've basically come from 0 up to 4% or damn close to it. And where do they go? Do they go up to 5 or 6? I don't know. But I think my things I'm looking at are employment's a lagging indicator, inflation's a lagging indicator, and I think as these rate hikes move their way through the system, we will likely see lower inflation. So I think it's kind of peaked.
So one thing we know is that households have significantly higher costs for servicing debt, which reduces their ability to consume, and as a result, as they purchase less, as they consume less, then we start to see the economy slow, and as the economy slows, of course, that brings inflation down.
Yeah, and
when you talk about the Federal Reserve or even other central banks managing stock markets, you're suggesting that they're trying to get some of that lofty overvaluation that we saw in 2021, continue to get that out of the market, and so we're talking about the potential for somewhat better value for equity markets down the road, right?
Yeah, absolutely. I think they just want to remove leverage from these risk assets like equities, cryptocurrency, whatever it might be. They want housing. They want to remove leverage, and that will, as you said, naturally slow the economy down. One other thing I was going to mention, Scott, they seem very focused on the level of employment in the U.S. And just anecdotally, if you look around, I mean, today I haven't seen the news yet, but certainly came out yesterday afternoon, Sunday afternoon. This is being recorded at 11:17 on Monday the 7th. But Facebook Meta is supposed to be laying off thousands of people. These big tech firms are going through massive layoffs, and these are high-paying jobs. These are not lower-end service workers. These are very high-paying jobs. So that to me is anecdotal evidence that things are starting to turn. So
well, and that poses another issue for the economy, because if people who households who have higher debt loads are becoming unemployed, then there's the potential for bigger sales of assets that they own in order to raise some cash in order to pay their debt servicing and to pay for their lifestyles.
No, for sure. That begs another question. There's so much structural debt in the world now, both corporate, government, personal, that if the Fed keeps at it and that blue line goes up towards 5 or 6, boy, oh boy, like it may not be a recession. It may be far worse. So it could be catastrophic, and that's what, you know, markets are looking for, the Fed to pause and the so-called quote unquote Fed pivot. I don't know if they're going to pivot anytime soon, but it would sure be nice if they pause, because I think that helps funding, and it certainly helps every other sovereign nation in the world that funds itself in US dollars, because it's been catastrophic for them, whether it's emerging market economies or even other developed nations. It's this US dollar has just been, up until the past week, been on a complete and utter tear, like bubble-like in itself, and in such short supply that the Fed is now having to do what are called US dollar swaps with other central banks, like Bank of Switzerland, I think, has done the largest over the past month, the largest US dollar swaps ever. Bank of Japan, I think I read something a month ago that they bought more Japanese yen in the open market to support the yen, which was getting hit down so dramatically against the US dollar, than they did in the 1998 Asian credit crisis.
And all this is intended to just maintain liquidity, so that liquidity itself doesn't dry up in the system, like we saw in 2008. The system comes to a grinding halt.
Yeah, yeah, absolutely, and that for sure will bring in a pause and possibly even a pivot from the Fed.
Right.
Once credit markets seize up, then they're going to pause and pivot.
So let's move on. Let's talk about our models. Again, we've been poised to do some buying. We did a little bit of buying, adding to portfolios in June. We worked over the last couple of weeks to put prices on some of the securities that we do want to own. We are still a little overweight on the cash equivalent side, and there are price points that are below the market currently, and it's just a function of value. And as we talked about, we could see the price to earnings ratio, which is a common used valuation methodology, pull back to its historic averages, and that represents great buying opportunities for us. So we want to have a little bit of cash, but we put our prices for the securities that we want to own in at lower levels in order to take advantage of when and if it happens that prices continue to come down a little bit further. And I think there may be another wave of price discovery to the downside, and we're poised to do some buying and pick up some value when that happens. Talk about the tactical strategy, Paul.
Yep. Really just a couple notes here. We didn't really do any additions or subtractions. Well, we had one subtraction, which we might have mentioned on the previous call a month ago, but one of our larger equity positions in here, Yellow Media, was a third of the position was taken out through what's called a plan of arrangement in a substantial issuer bid. So they took out a third of the outstanding stock at, I think it was $12.57, if I'm not mistaken. And not really a level I would have naturally sold at, because I think it's worth a fair bit more. So that was one item, and the other one was we have a bond that's in our tactical model, a high yield bond that they restructured their credit facility. So they were banked by lead bank was Bank of Montreal. They got rid of them. They got two private credit facility providers in place, and they actually didn't pay their coupon from August. They pay every quarter, and for that, as bondholders, we were able to work with the company and the new lenders of the credit facility to get what are called better covenants in place, and also a consent fee of 1 point. So that bond, in my opinion, is structurally a little bit more secure than it was previous to this announcement. So that was good news. But I think that's about it for tactical. We still obviously own our main energy position, certainly in the equity side, is Baytex Energy, and we have no plans to sell that. Still very bullish on fossil fuel energy exposure here. both oil and gas, and then we have a couple other positions that are either directly related through the bond side or some more, I call them like energy light positions on the equity side, like an Enbridge, TRAP, etc. So that's it for tactical, Scott.
Excellent, excellent. Let's talk a little bit about fixed income and most balanced portfolios that we have fairly significant exposure to fixed income and to investment grade and government bonds. The conversations that I've been having with clients recently have centered around, what are we doing about the fact that, bond prices are down so much because interest rates are rising? Are we concerned about this as we go forward? And my response to most people is that, really we own bonds as a long-term investment instrument for the most part, and bond prices inevitably, as they approach maturity, will come back to their issue price. So even if they are down now, as they move to maturity over time, those bond prices will come back up. And so we have to mark everybody's portfolios on the day-to-day pricing of where bonds are currently trading, but you have to keep in mind to a degree that a good chunk of your of the negative part of your portfolio that is a function of bond prices. A lot of those bonds are going to come back to mature at their original par value, and by virtue of that, will appreciate over time and help to alleviate some of the negativity that you're seeing in the portfolio at current price levels.
Yeah, it's good point, Scott. So I'll preface any changes we had here by saying that's a good point that all the bonds, most of the bonds anyway, are marked market every day. Some of the corporate bonds in the tactical model are marked more monthly at month end, but regardless. So if you have, for instance, we have, quite frankly, some investment grade bonds, government bonds, and high yield bonds, as you can see on the pie chart, that are trading, let's just say, at 85 cents on the dollar. They might have 1, 2, 3 years left to maturity. Those bonds will do what's called pull to par, as you said, Scott. They mature at par. Now, failing a restructuring or bankruptcy, if you will, or default on a corporate bond, or let's hope that never happens in government Canada, and highly unlikely it won't. But a high yield bond or even an investment grade bond, if they default, then yeah, sure, you may not get your par. But do remember that the high yield bonds held in here in this fixed income model are higher rated, typically single B or double B rated issuers. Some of them you would name brands that you would know, like Air Canada, Parkland Fuels, which owns pretty much every gas station, retail gas station in the country now. There are a few others, just actually looking here, any name, Videotron, so that's Quebecor's cable and mobile operator. That's a solid company, and the bonds are trading at 84 cents on the dollar. So over time, number one, we're collecting coupon interest every day we own that bond, and B, as the years go on, it's going to pull back from 85 cents on the dollar towards par. So right now,
par being 100, right?
Right, exactly. And every day we hold the bond, we create interest income for ourselves. So that even goes with some of the investment grade bonds, like TELUS, which is one of 3 massive ILECs or incumbent carriers. There's a bond, it's marked at 91.5 cents on the dollar, so it's 8.5 points below par, being 100. TransCanada Pipeline trading at 93.5 cents on the dollar. So it's been absolutely horrible in the fixed income space, especially in interest rate sensitive securities within fixed income. So government bonds are the worst, then investment grade, then high yield, and some distressed bonds are quite frankly unchanged, which is great. And we do own some of those, but in the tactical model. So what I would say, is in fact, we're actually getting a little bit more bullish, and we are tactical and active in all three of our models. So I would say over the past month, we've been underweight in both government bonds and fixed income. So that's actually, believe it or not, helped us a little bit. And we've been underweight investment grade bonds a little bit in the fixed income model. So what we have done is, quite frankly, taken advantage of this big sell-off, and we added a little bit in our 7-year Government of Canada weight. We added a little bit in Videotron, which I just mentioned, which is like an 8-year bond, 7-year bond really. And we're actually in the process, it hasn't even gone through your portfolios yet, it should go through today or tomorrow. We actually are in the process of adding a fixed rate preferred share, which we just started buying in the first week in November. And that being, this is, quite frankly, it's got out to like a 6.5% cash yield right now, and that's up substantially. So we will look at maybe adding more of those and rotating into those fixed rate preferreds and out of the rate resets, which are floating every 5 years, as we think maybe if inflation has peaked, rates have peaked. Now, we may not be there yet, but again, we're never going to find the tops and bottoms in any market or any security. So we tactically just tweak our portfolios by adding a little bit. So we have actually added a little bit of interest rate risk here over the past, certainly the past month, but even over the past couple of weeks. Is that helpful, Scott?
Excellent. Excellent. That's great. And always, if anybody has any questions with regards, I know we talk and can talk a little bit in detail about these things. And if there are any questions, there's no such thing as a bad question. Please just get in touch and ask the questions that you would like. We often have great conversations as we help clients understand exactly some of the talking points that we have in these videos. It's great to be able to help clients understand a little bit better those things those concepts that they may have a little bit of difficulty understanding. So there's no such thing as a bad question. Feel free to contact me or contact Paul at any time, and we're happy to dialogue.
Yeah, I would echo that for sure, especially fixed income. It's they're not listed securities. They're kind of airy-fairy and nebulous, and people maybe don't understand them quite as well as they should. So absolutely, I echo that. If you have any questions, no dumb questions at all, just contact us, email, call.
Absolutely. Okay, thanks, Paul. Everybody should now have received their quarterly reports. Paul and I very specifically sent them out individually, and the reason behind that was to make sure that they didn't wind up in your junk mail. If you haven't received them, please get in touch. I did in my email ask clients to get in touch to set up reviews. There's still a significant number of clients who haven't had reviews in quite some time. Very important that we do this from a regulatory perspective, but also because we want to hear from you. We want to have a conversation. We want to understand what's going on in your worlds, and if there should be any adjustments to your strategies. Very important for us to know that. So many have not yet got back to me with regards to the reviews. I have had, I'd say, about a 10 to 15% response, so that's pretty low. And I'd really, really urge you all to get in touch as soon as you possibly can, and let's set up a meeting or a review, and let's get everything and your circumstances all updated. All right, that's a long one this week or this month, so we'll end it there. But thank you all for tuning in, and I hope you have a great month of November. we'll be back. I can't even believe it's going to be the beginning of December the next time we're here. I mean, we're running almost down to the year end. So nonetheless, we look forward to sending our next update in December. And until then, look after yourselves.